As Stephanie Link, I start with you. I want to start with something you sold. You sold 3M because you sold it to fund some of the buys that I'll talk about in a second. But tell me why you got out of 3M now versus something else.
It's a little bit of tax loss selling, not down that much in it, but I do think the recovery is still very attractive for the long term. I just think it's going to take a little bit longer. So within industrials, I just think that there are better opportunities that have more upside in the near term, and that being
Union Pacific is one.
You want me to say it? Yeah, so Union Pacific is one. This company has a new CEO, Jim Vena. He was at Canadian National for 4 decades, and he did a great job. He was the COO of Union Pacific from 2019 to 2021, and he was able to find $1 billion in efficiencies under his leadership. So now he's the CEO of the company, and it was announced in July, and the stock popped on the news. And now the stock has been stagnant since then. And in the meantime, since August, we've seen car velocities up 8%, train velocities up 10%, operating car inventories down 2%, and weekly car loads on average up 6%, meaning fundamentals are getting less bad. They're actually getting a little bit better. And I think they will be able to see a substantial improvement in margins. That's what he does. And so I think you can go from an 18% decline in earnings last quarter. Fast forward a year, I think you're going to see 21% growth. So I think this is a great story, and it's a play on Jim Vena for sure. I'm
going to get to this other one in a second. Who owns AXP?
I do.
Okay. Can we show shares of AXP? I'm glad you do, because we'll get back to the move in a second. I do it because I don't want to sit on something that's moving rather dramatically lower at this very moment. It is Amex. It's down 3.5%. The CEO is speaking as we speak at a Goldman conference right now, in which they said, and I quote, didn't see growth in October like it was in the third quarter. I think there's a lot going on in October. For November, you're seeing a little bit of a slowdown in air, a little fewer transactions, maybe a little bit of decrease in transaction size. But overall, for the year, it's been pretty consistent with us, for us, with double-digit transaction growth, and that continues. So those comments, Steph, are being made really right now, and the stock obviously is reacting.
Not really surprising, though, because we're going to go from almost 5.2% GDP in the third quarter to we're now running Atlanta Fed at about 1.8%. So we are seeing a slowdown. If you heard Brian Moynihan on one of the earlier shows this morning, he said the same thing. Consumers still fine, but they are seeing a slowdown, as you would expect. This is exactly what the Fed wants to engineer. And I think the data points, we'll get into the macro a little bit later, but I think the data points today that we got in terms of jolts is showing that we are seeing a slowdown. At the same time, the services segment of the economy is still doing quite well, and new orders are the best since August. So I think we are going to be able to handle these higher interest rates, but it's going to be a little wobbly in terms of the trajectory of GDP.
I think part of the point, too, is we really can't afford that much slippage, if you will, from the consumer. One of the things that's gotten us here is a pretty perfect consumer, right, yeah. Joe? I mean, the other parts of the economy have been reasonably negative for a long period of time, right? Manufacturing gone through a recession, et cetera. The consumer has been all pretty much perfect, keeping us thinking that we're going to have a soft landing. Can't have any slippage in that.
So we own we own Amex in the JOT ETF as well. This pullback to me is an opportunity. This is a stock that has outperformed so far year to date. It's up 15%. This is a stock that, remember, doesn't have the credit risk that the rest of the banking community does, correlating to where the consumer is on their ability to repay a lot of their debt. It caters to the affluent consumer, as Stephanie has said. I actually think in an environment where the economy begins to contract, American Express is actually the one financial name that stands out above all the rest. So seeing where it is right now, I will defend this stock backwards and forwards, both fundamentally and technically, and I say you buy it.
100% agree. It's trading at 15 times forward estimates, too, which is well below its historical average. This is best-in-class company. You look for days like today to buy best-in-class on sale. That's what this is.
Okay, I didn't mean to steer you away from the middle of the moves that we were going through, but I just didn't want to sit here and wait to get to a substantial stock like that was seeing a decline. Sherwin-Williams is the other one that you bought.
Yeah, and I've never owned Sherwin-Williams. I've always watched it, though, but I like it because of housing. I think 2024 is going to be the year of housing recovery because interest rates are coming down. We've seen mortgage applications come down the last 4 weeks in a row after rates have pulled back. So I think that's a nice tailwind for this company. They have a very attractive price-cost mix acceleration story to be told for 2024 as input costs come down, pricing stays firm, and we're still so undersupplied in housing. I know we're going to talk about housing a little bit later, but this company will certainly benefit from the 13 years of underproduction that the home builders have done over the last 13 years. So I think that's going to be a positive for them, and I think that this company can grow mid-single digits in revenues and upper single digits in earnings, and I think they could see $12 a share by 2025.
The other stock that's on your radar today that you bought a little is they're having their investor day today, I think, is Johnson & Johnson, right?
Yes.
Why'd you buy J&J?
I didn't buy it for the analyst day. I bought it really because I think, I like spins, and they finally did spin Kenvue, and it was a little noisy in the beginning of that transaction. So now they still own 9% of Kenvue, which is perfectly fine, but I do like their pharmaceutical business, which is 65% of total revenues, mainly on their cancer franchise. They've gone from $2 billion in cancer in their franchise 10 years ago to $12 billion last year, and I think that's going to grow substantially over time. I also like what they're doing in medtech. They made 2 big acquisitions, though that business is going to grow very nicely as well. The stock trades at a 5- and 10-year discount to its historical average. It has 3.1% dividend yield, and it's grown that dividend for 61 straight years.